exponentially, which is fantastic. It means we've got a really important topic to cover with all of you. So it's wonderful to see you, all of your faces, and it's wonderful to see all the participants who will, we hope, have some time to engage in the conversation with us at the end for a Q&A session. For those of you who may not know FinRegLab, I want to start off by sharing a little bit about the organization. I am Melissa Coity, and I established FinRegLab 3 years ago after spending time in the U.S. Treasury Department. I stood up FinRegLab as a 501c3 nonprofit research organization with the intention of providing independent, non-advocacy, fact-based research insights about the implications of the use of technology and data in our financial system, and ultimately to undertake research that would help to inform how we are evolving the safe use of data for financial purposes and the safe use of technology for financial purposes and financial inclusion purposes, and ultimately to help inform the broader stakeholder community as we all need to understand the implications of any particular data use or technology use and how ultimately that can be brought to bear for the benefits of financial inclusion and increased financial well-being of consumers and small businesses. So it's a real pleasure to be with all of you today and the many of you who are joining us by Zoom. I want to set the table a little bit by providing some of the insights from research that we undertook over the past couple of years, which involved engaging some of you directly in the work that we've done, but I think it really helps to set the stage for the conversation we're having today, which is about the evolution of our credit system and the importance of that at this particular moment. So when we embarked on this research, we began by wanting to assess and understand what the benefits and what the major risks and considerations are when deploying new types of data in credit underwriting, especially for consumers and small businesses. And we set out to evaluate a type of financial data, but an alternative type of financial data to really understand the implications for financial inclusion, the implications for its ability to actually predict risk, and its implications for fairness concerns and fair lending issues, and in particular, disparate impact risks and questions that industry and regulators and policymakers have about bringing in some of this new data. And so with engagement with 6 lenders, we evaluated financial data, transaction data, literally the information that one can glean from a bank account or even potentially from a prepaid card account, which has real relevance for inclusion purposes. But we looked at this transaction level data, loan level information, and assessed, are those data, and we were looking at inflow, outflow, balance information, are those data indicative of credit risk? How do they compare with traditional credit data? Are they enabling lenders to extend products to populations who otherwise would have been turned down? And really importantly, are those data creating a disparate impact risk? The work that we do involved this evaluation. The findings there, in short, are that the data are enabling lenders to predict risk. They are enabling lenders to evaluate risk that is distinct from what they can glean from credit bureau data or the metrics the credit bureau scores. The data are enabling lenders to extend credit to populations who otherwise would have turned down, both on the small business side and the consumer side. And you can read all about the details of our findings in our reports. And very importantly, and this is always an important caveat, there is an extensive evaluation that any lender would and should be doing for evaluating disparate impact. But what we were able to do is assess, are these data proxying for protected classes? And there we found that the data are independently predicting risk. So we were pleased to do that work. We are building out additional work in the credit underwriting area that we will share with everybody in the near future. We also are pleased that that type of research that we did and the work that we undertook and engaged many of you who are participating in this webinar with me today, and many of you who are participants vis-a-vis Zoom, that research really helped to inform the understanding and the openness to actually begin to adopt new types of data, and this particular data in particular. Late last year, the federal regulators issued a joint statement expressing an openness to looking at what they called alternative data, and in particular, the notice called out cash flow or transaction level data is a type of alternative data that may have inclusion benefits. And we've also seen activity happening at the industry level around the adoption of this data. We think our research is also really helpful, I think, just to even just recognize sort of the vast number of people who may be operating either at higher prices or not able to access credit. We have up to 60 million US adults in the United States who, under more traditional underwriting methods, are deemed too thin in terms of a credit history. They may not have any credit history at all, or they may be non-prime, where this type of data, again, because it's offering a nuanced understanding, may actually be indicative of risk in enabling these populations or these individuals to be credit risk assessed. So we are also stating the obvious here at an unprecedented moment, both in light of our collective attention on the need for addressing the generations of racial inequality and how financial access and credit scores and credit underwriting play into overcoming those generations of inequality, especially with respect to race, and how much the financial access and our credit system play into the opportunities that ultimately will result in greater equality, whether that's access to home ownership, access to entrepreneurship, the ability to begin to build wealth for the longer term, and the multi-generation effects that wealth building opportunities ultimately bring to bear. And I think that's in big part too why many of us are sitting around really trying to push hard and think and identify ways that new types of data can potentially be utilized so that we are making sure that everybody who can prudently be credit risk assessed is able to be brought into credit access. At the same time, we are in the state of a global pandemic. Why all of us are sitting here together on a Zoom line as opposed to sitting around a table or a meeting room here in DC. And that also means that we're having to pay a lot of attention to the data that are used traditionally. And there is attention to the fact that those data may be lagging indicators of risk, especially in this moment where the economic environment and job security is such varied across the country. So here we are today to talk about the state of the world that we're in and where the credit system is headed. We've got a fantastic group of experts on credit access, credit systems with deep expertise, both from industry, from the fintech sector, from the consumer advocacy community, the small business lending sector, as well as the regulatory community. We've also got, as I said at the top, over 200 people who are joining us by Zoom. Thank you, those of you who are joining us. And I just also want to say thanks to many of you who have sent us input about this session, even in advance of today's conversation. We hope that we've incorporated some of your expertise and your questions into the discussion we're going to have today. I also want to point out that this is one of a series of webcasts that are happening that are focused around fair finance. The next event will be happening next week. The Financial Health Network, who many of you know, will be hosting a discussion. It will include actually somebody from the FinRegLab team, Kelly Cochran, where they're going to be focusing on data access and evolving the systems and the policies with respect to data access. So now let's turn to our discussion. What we're going to do is we're going to kick it off with quick introductions so that those of you who are watching and zooming in have a sense of who's participating in this conversation, but we really want to get into the heart of today's conversation with everybody. So we're going to do quick introductions. Gravetta Gardner, would you kick us off and introduce yourself, please?
Absolutely. So thank you, Melissa, and good afternoon, everyone. I really appreciate the opportunity to be with all of these panelists and to talk to your audience today. I am the Senior Deputy Comptroller for Bank Supervision Policy and Community Affairs at the Office of the Comptroller of the Currency. And prior to that, I held the wonderful position as the Senior Deputy Comptroller for Compliance and Community Affairs, with particularly keen focus, if you will, on fair lending, fair housing type of issues. That continues to be a part of my policy-making wheelhouse. And I am actually very much engaged today in Project Reach, which is a initiative sponsored and I would say the brainchild of our acting comptroller, Brian Brooks. This really came to be as a result of so much of the social unrest that he and the rest of us have witnessed across the country as a result of the murders of so many African American males and females that we have unfortunately had the sad opportunity to witness collectively as a country while we've been isolated due to the pandemic. But what Acting Comptroller Brooks brought to me and the rest of our executive committee was the concept that so much of this unrest was fueled by people challenging the system and the system being broken. And he particularly focused on the fact that perhaps it's not as broken as it is exclusive to so many people. So Project Reach has a number of work streams, which I'll talk about throughout the course of the webinar. But the one that I have the keen interest in, and the one I'm leading on behalf of the agency, is focused on credit invisibles, that 45 to 60 million you referenced a few minutes ago, Melissa, who are not in our credit system, either by choice or circumstance, and what we can do to bring them into more mainstream credit and help build that generational wealth you were referencing. So thanks again, and I look forward to the conversation today.
Thank you. We're so pleased to have you. Chi-Chi, would you like to share where you're coming from, your background?
Sure. Thanks, Melissa. Thanks for having me on. I'm pleased to be able to speak with such a distinguished panel and such a distinguished audience. I'm a staff attorney at National Consumer Law Center. We're a nonprofit that focuses on consumer law issues with a particular focus on low-income consumers. We come out of the legal services movement, which is the field legal services across the country that help low-income individuals with a variety of legal needs, including consumer law needs. And so, you know, my bread and butter work, it focuses on the Fair Credit Reporting Act, credit reporting, credit scoring, working with legal services and private practitioners to hold credit bureaus accountable for mistakes and errors and all sorts of problems. But certainly over the many years of doing this, have gotten involved in examining alternative data and what that means to consumers, whether it's beneficial, whether it's harmful, you know, what are the safeguards that need to be put in place, and you know, what are some of the privacy and fairness implications. And then every once in a while, they let me out to think even bigger in terms of big picture issues and to talk about things like racial disparities in credit scoring and how they are a reflection of underlying racial inequity that's gone on for decades and centuries. I also work on a few other issues on the side, credit cards and medical debt.
Thank you. That's great. Looking forward to talking about a number of those topics. Michael, would you introduce yourself?
Sure. Good afternoon or good morning for some of you. My name is Michael Rappaport. I run the small business lending organization for the Opportunity Fund. Opportunity Fund is the largest small business focused nonprofit community development financial institution in the US. For those of you who know community development financial institutions, you know that our basically mandate is that we serve low income and minority borrowers helping them get credit. In a lot of cases, these are underserved organizations that really need our help. They are your Main Street small businesses. I have been at the organization for 3 years, and prior to that spent 28 years in for-profit organizations around lending, including 14 years at FICO, where I developed some of the original FICO credit scores back nearly 30 years ago. So I'm really excited to be here and excited to talk with you all. And I'm humbled to be part of this panel of experts. So thank you.
Well, thank you for being with us. Jason. I can see you trying. There you go.
A little bit of trouble coming off mute. We're good. So hi, everybody. And thanks so much, Melissa and FinRegLab for having me. It's, as the other panelists have said, it's really an honor to be on this fantastic panel of experts. I'm looking forward to the discussion today. My name is Jason Gross. I'm the co-founder and CEO of a fintech company called Petal. I'm also a former member of the Consumer Advisory Board of the CFPB, having just served on the last term. Petal is a consumer fintech company with a mission to expand access to safe and responsible credit products. We specialize in credit card products that are designed specifically for historically underserved consumers. And we do this primarily by way of cash flow based underwriting. Over the last few years, we've pioneered a fully automated consumer underwriting process that leverages banking history, so leverages alternative financial data, in addition to traditional credit data where available, to predict credit default risk. The approach has allowed us to serve consumers even if they have no credit history or if they are thin file, like the tens of millions of consumers that have been mentioned already on the panel. And those consumers are disproportionately minorities, first and second generation immigrants, low and moderate income consumers, and young people. We've been quite successful in using this approach. We have just under 100,000 users today. We have years of performance history now in the use of these models, including performance through rocky economic conditions in the COVID-19 recession. It has allowed us over the years to literally score people that were previously considered unscorable. But we've been breaking a lot of new ground. There's been a significant number of learnings along the way. And I'm excited to share some of those learnings today and what they may mean for modernizing, improving, and sort of ultimately democratizing access to the legacy credit system. I should also say that we were one of the participants in the FinRegLab study on cash flow based underwriting last year.
Yeah, thank you, Jason. We have about 10 minutes, and I don't see our other panelists to have him introduce himself, so I will do my best. Larry Rosenberger is also...
I'm on.
You are, fantastic. Larry, please introduce yourself. I just don't...
So here's some things you should know so you it has the context for my comments. The first thing is I'm a geek. I studied physics and operations research. I've been at Fair Isaac for more than 40 years. So I did the CEO job when this Michael Rappaport showed up and became a superstar. But the other thing that affects me and my thinking is that I've started working with early stage fintechs for about the last dozen years. And then also I was on the Edgar Dunn Underserved Roundtable for about 6 years until they dissolved that one. And I was also on your project as just one voice around the table.
That's right. I think you and I met through the Edgar Dunn project, actually, at least half a decade ago. So I told everybody at the start, we had a lot of years of expertise to share with all of you and for this conversation in the credit system. So thank you, everybody. We have about 10 minutes, and there are a couple of core themes that I just want to make sure we get on the table in the context of why now is in the moment. And Chi-Chi, I think it would be great to start with you. And if you could just sort of set the table around what are the vestiges as well as the current iterations that relate to racial inequality and the credit system And ultimately, as I said at the start, how they play into so many other aspects of building fairness and fair access around employment, education, and the list goes on. If you could start us off there.
Sure. Thanks, Melissa. And that's absolutely a great question. Why now? Because we've known for years, if not decades, that there are some really extreme disparities in credit scoring, all the way from studies in 1996, 2007, a key Federal Reserve Board study that found that the mean credit score for African Americans was 25.6 versus 54 for whites, and this was normalized on a scale of 1 to 100. To a study released last year by the Urban Institute based on 2016 data finding that over 50% of white households have FICO scores above 700 compared to 20.6% of Black households. So we've known this for a while. We've known for several years that these disparities are probably linked to the racial wealth gap, which is the fact that the disparities in wealth between white families and Black and brown families are significant and way bigger in scale than income disparities. And in fact, the Fed just came out with its most recent triennial survey of consumer finances and reported that the median wealth of white families is $188,000, and compared that to only $24,000 for Black families, about 15%. So that's a pretty huge difference. And that is part of the reason for these disparities in credit scores. If you think about it, we are in the middle of a huge economic crisis and a huge health crisis. And if someone has lost their job because of COVID-19 or shutdowns, it's a lot easier to keep paying the bill if you have $188,000 worth of assets versus $24,000. And the ability to keep paying those bills gets reflected on credit reports and in credit scores. So how did we get here to this massive wealth gap? And this is also where we get a sense that this moment is important, because it's not an accident. And a lot of the work and focus these past few years and these past few months on racism and inequality has shown it was very deliberate. I mean, how can anyone think that hundreds of years of slavery and decades of intentional government-backed discrimination wouldn't have an impact on credit scores? And so we know from the work of folks like Richard Rothstein and others that over the past decades, you know, the vast majority of middle-class wealth in this country is housing wealth. It's in your house. And Black families in particular were excluded over the decades from building that wealth. If you think of that, the greatest expansion of that wealth was right after World War II. GI Bill, the Levitt Towns, FHA, and all of those excluded Black families. Residential segregation that was backed by the government excluded Black families. And as a result, less housing wealth, less wealth to use for education, small businesses, and you can see it in credit scores. And you know, that would be okay if credit scores were just a measurement tool, a research tool, if you wanted just to see differences. But they're also used for access. They're used for access for credit, for insurance. Credit reports are used by employers. They're used by landlords, so many important things. And so because they're used to make decisions, you're reinforcing those disparities structurally, even without any intentionality. And so the way I've been analogizing it, and it's not a great analogy, so if there's a better one, please tell me. And I hate this term, but golf handicaps. Are any of you guys golfers, right? So, you know, there's this concept of a golf handicap, and I know I'm mangling it a bit, but it's the idea that if you get a certain score and it allows, you know, novice golfers and experienced golfers to play together because it's higher for novices. Well, credit scores are the anti-golf handicap. It's a penalty to reflect past and current discrimination, and it's docked from your credit score, and then that score is used to make decisions about you. And I say current discrimination because it's not just a vestige. It really, it's happening now. I mean, if anything, the last 4 years have taught us there's a lot of current discrimination. I mean, just look at criminal justice, right? Criminal justice and policing, disproportionate impact on Black families, which shows up in credit scores. There's a study out of Baltimore, the Washington Center for Equitable Growth, that shows that whether or not someone in a household has been incarcerated is strongly correlated to credit score.
Right. Yeah, these are table setting matters that are really important to get on the table and make sure that we're thinking about, and why it is so important that we're thinking now about inclusion. And we're going to get to, at the latter half of this conversation, what you're speaking to, I think, or anticipating are what are some of the ways to help potentially address and create some increased access opportunities that are more balanced. So that's really helpful. Jason, I know we're not going to have you for the whole call. And the other sort of table setting question is, why are alternative types of data useful in this COVID moment? So if you could share with us a little bit now about what you've seen and how you're thinking about the potential use of alternative data and cash flow in particular. I won't answer your answer for me. So if you would jump in on that one.
Sure. Yeah, I'm happy to. And I think that part of this first topic for discussion is to do with the why now question. I think people have been thinking about alternative data and alternative methods to assess creditworthiness for a very long time. So what's changed that would make this the moment where we could see really significant change or differences? And I think that one, we've learned a lot from the COVID crisis in seeing some limitations or cracks in the legacy system from a pure statistical relevance, a pure business perspective. But then I think second, when we think about, and reflecting on Chi-Chi's comments, when we think about the most significant historical events so far in 2020, we have to think about re-examining the system and rooting out systemic racism and so on. And I think there we also see ways in which the credit scoring system needs to evolve, or needs to change to be truly equal. So both of these, massive historical events, the Black Lives Matter movement for racial justice and the COVID-19 pandemic and associated impacts on the economy, both of these events sort of give us occasion to re-examine the legacy credit system. So a few of the observations that we've had over the course of the year, credit scores are a lagging indicator. We know that. They take a long time to reflect recent changes in the financial life of a consumer. Typically information is reported once obligations are significantly delinquent. So a credit score can appear to be just fine when really a consumer is in great financial distress, and vice versa. And during COVID-19, over the course of this year, we've actually seen an increase in the average credit score of U.S. consumers, which would indicate that U.S. consumers on the whole are becoming less risky. That, of course, is not the case. We know that is not the case. We have tens of millions of people that are out of work. But between the fast changes in the economy and then all of the modifications and extensions and things that have been granted to consumers to keep up with their obligations, we have confused the traditional metrics such that they're no longer as reliable as they were before. And if you're a lender that uses just traditional data, traditional scores, in this moment, you could be very confused and hesitant to make the typical lending decisions that you may make. And so what do we see on a macro level? We see a massive pullback in new credit originations. We see more constraints on access to credit than we've had in 10 years. That's the result right now. And while credit information has been noisy and potentially misleading, some of these alternative sources of data, and in particular cash flow data, have continued to be very accurate. Income information, cash flow information, asset information, all of that updates much faster than information from the credit bureaus. It can reflect whether someone's currently receiving a paycheck, whether someone has savings sufficient to meet their obligations, and all of those sorts of things. And so as a lender that uses cash flow information, we've been able to continue making credit available with confidence, even during this period of time where the volatility has maybe put a thumb on some of the scales that others are using. So that's one. And then when it comes to racial justice, these are obviously very, very large topics. But just not only do you see that the average credit scores among African Americans are significantly lower, you also see that African Americans are far more likely to be credit invisible or thin file. The disparities in access from the past ripple into the future. In addition to, I think current racism and limitations on access. To give you an example, we spend a lot of time with consumers that are brand new to credit. And there's about 20% of consumers, young consumers, that gain access to credit with a parental cosigner or guarantor to begin building their independent financial life. That presupposes that you have a parent that has a high credit score and can access a product on your behalf. And so if your parents were not able to purchase a home because of redlining and haven't built credit scores, then you are beginning your financial life today at a disadvantage without the ability to inherit that improved standing. And when you think about what data factors into the traditional system, mortgage payments improve credit scores, rental payments do nothing. Alternative financial service providers, payday lenders, et cetera, that are more commonly located in low-income areas and minority areas do not tend to report to the credit bureaus. So the payment history you may develop in using those products doesn't count towards building a score. All of these sorts of things lead to a skewed assessment of readiness if we use just traditional bureau data. Transactional information does not have these same inherent biases. And so long as we can bring people into the system in terms of giving them basic bank accounts, which we've done a better job of over the last 20 years, folks can develop the data that they need to show their own creditworthiness. If we're able to evolve the way that we think about underwriting from a lending perspective.
Yeah, that's super helpful. And you're putting your finger on markets that aren't sufficiently understood with existing data that we use. This moment in time with the ability to expand upon the risk assessment, going beyond what traditional data tell us. You all are offering a credit card. That's one asset class. I think it's also important to hear from you, Michael, as we think about the small business community and the potential for using new types of data for credit risk assessing in small business.
Sure. In fact, I'm going to probably just reiterate some of the things that Jason already talked about, but make it more specific to small businesses. Historically, small businesses, when we underwrite them, you have to consider, not just credit information, both from, consumer credit bureaus, especially for the smallest of small businesses that we typically serve, that tend to look a lot like consumers because a lot of them are sole props, for example. Mm-hmm. The commercial credit bureau as well, but in many cases, some of the folks that we serve are not, formalized businesses and therefore don't have formalized commercial credit, and therefore they're not, there are no hits on a commercial credit report. So we've always had to look at alternatives, and one of the obvious ones is understanding the cash flow of the business. And traditionally that's been done with tax returns and bank statements. And for the borrower, it's pretty hard to get all that stuff together. And the great thing is now we have solutions out there several of them like Plaid, Finicity, et cetera, who help with analyzing, the bank statements and analyzing and helping with the cash flow. So those are all tools that are, more useful and very useful for small businesses in particular. But then you layer on here COVID, and while COVID is its unique form of recession, right? No one anticipated this kind of recession, although we all anticipated some form of recession, right? So we had to be prepared for that. But this one in particular, I think, requires us in particular to look at the business before, during, and after in many cases. And, there's also another shift that's going on, and that would be around, traditionally, especially CDFIs, have boots on the ground who will go locally into communities to help borrowers, to find small businesses and help them. And that provides an element of, the traditional site visit, so to speak. You've seen the business, right? You've seen it in live. Well, our folks can't go out these days. It's not safe, so to speak. And anyway, with the advent of online lenders and such, there has to be a seed shift in understanding the fraud component as well for small businesses. And so leveraging fraud data and other fraud consortiums, and even solutions, one of the solutions we use is a company called TruePic, where you ask the borrower to take some authenticated photos of their business so you can actually get a feel for it. So I think all of that combined is, I think, the evolution in small business lending in general, specifically for COVID, generally in a recessionary kind of way. And the fact that a lot of the small businesses that we serve, being not as formal as others, require you to really look in differently. And so the time right now, if we don't help these Main Street small businesses get through this, Main Street will be unrecognizable the way we've typically seen it. Your dry cleaner down the street, your local restaurant, your local nail salon and hairdresser. These folks are the ones who are struggling. And if we don't find ways to help them with their needs, and their needs are not huge, in many cases, $20,000 small business loans are what they need.
Right. Right.
When we did our PPP loans, our average PPP loan size was $15,000. So that kind of gives you a sense of what these businesses are generating. And so, obviously the time is now because of a global pandemic, with an economic pandemic, with racial injustice pandemic, and all the things that come with it. But frankly, the moment was already here anyway.
Yeah, you're putting your finger also on the really sort of micro loan needs, whether it's consumers and small dollar credit or small businesses and very small businesses. And it does raise the questions around the efficiency and the potential for how data may be accessed at, affordable, what's the infrastructure by which data can be accessed at affordable rates that make extending credit products to, smaller dollar or smaller amounts economically possible up and down the financial provider side. Gravetta, you all, we'd love to hear more about Project Reach and what you all are doing to try to think about some of these, this is my word, not yours, but infrastructure plays, if you will, because, the ability for this type of new data to be used efficiently and at cost-effective rates comes back to an infrastructure. So, but generally, tell us about Project Reach. I know a lot of people would love to hear about it.
Okay, thanks. And I think that all of the points that have been made so far are so relevant to what we're dealing with, and it all comes back to your primary question: why is today different? Why is this time? Why does it feel so different? And I do believe we're at this, juxtaposition of a healthcare crisis that's having a profound economic impact across the country, and the entire country, if not the world, is experiencing it at the same time. So it makes it very different than when you're looking or seeing something on the news that affects somebody that's a few states away or another country away. as opposed to a very shared experience, because these are our neighbors. You know, these are our friends and family, and we're all going through this together. So really that was a catalyst for Project Reach. And I tend to forget, but I think it's important for this audience to talk about that acronym, which is the Roundtable for Economic Access and Change. And really the whole point of this is to bring together the OCC as a convener, of bringing together individuals from the banking industry, community advocates, civil rights organizations, businesses, fintechs, to really look at what are these barriers that have prevented people from having access to credit and capital, and what can we do in that role as convener of all of these stakeholders to see what we can do to remove those barriers and really achieve, I think, 3 significant things. And those things are, one, the work stream I talked about earlier, credit invisibles. What can you do to deal with a demographic of consumers in the tens of millions, you know, somewhere between 45 and 60 million Americans who have no access to credit. But even deeper than that, they have no access to the financial system at all. So it doesn't have to be credit. It can just be, as Jason was saying, this is your traditional transaction account that is in the safety of a financial system, as opposed to the much higher cost that's usually paid by people of limited means. You know, I think I mentioned to you before, Melissa, but I'll say it again, it is incredibly expensive to be poor.
Right.
Poor people are charged the highest rates, or they don't, you know, they pay the highest fees. And so this is a way for us to look at what is that barrier to that credit or entry into the system. In many ways, it's the credit score. Chichi, you talked about that a bit earlier. That credit score has a top range and a bottom range, but if you don't have a score because you don't get paid on the traditional every 2-week, very traditional business income that is relied upon in order to build that score, you are not in that system. And there are people who are working, you know, they are gig income. They have cash flow data. They are responsible. They manage their bills. They pay their rent. They pay their transportation fees, car note, utilities, cell phone bills. Those things are not traditionally recognized. Yeah. And there must be a way, and we believe there's a way, to translate that into a model that can capture that kind of data and then provide that entryway into the financial system. You know, it is not the goal of this particular work stream on the credit invisibles to build a product. You know, the OCC doesn't develop products, we don't approve products, but we do think that there is a way to encourage the development of a different model that takes those types of cash flows and gig income and that non-traditional approach and model that in such a way that financial institutions can utilize it and build that into the scoring model, taking away some of those, you know, earlier barriers, if you will. One of the second areas and work streams is focused on affordable housing. And as we talked about, many of the panelists recognized earlier, that generational wealth has not necessarily passed down to people of color, and lower and moderate income individuals do not have that kind of access to be gifted that down payment that gets you into home ownership. So again, there's a second work stream that is totally focused on what is that barrier to getting into affordable homes and having that be the same opportunity to present that same foundation of generational wealth for this demographic of individuals that others are able to, I won't say take for granted, but it's a much easier path. It's a clearer path. And then the third is really the preservation of minority depository institutions across the country. They play a particularly important role in neighborhoods of color, minority neighborhoods across the country. And unfortunately, over the course of the 30 plus years that I've been a financial regulator, I've seen the number of minority depository institutions diminished, and it is shocking how fewer there are than when I first started in the industry. And so there must be a way to encourage others to provide access to capital to help sustain the minority depository institution in a way that they can continue to serve the needs of a community that trust them. And I do want to talk for just a few seconds about that trust element, because I think that's a common thread that runs through all three of these work streams that I've talked about. As far as an obstacle, low and moderate income communities, individuals, people of color may not have always had a relationship with financial institutions by virtue of getting to that home or getting to that credit card or that line of credit or that traditional bank account information. And much of that really is historically based on a lack of trust. And that trust, that lack of that trust, comes from a place that is rooted in our society for many years for many reasons. Various experiences have led to that. And so it's just a different obstacle that I'm hoping that all of these stakeholders that we are so fortunate to be working with can change that dynamic as well. I tend to believe that financial institutions do offer a level of safety. It's not the only access, but there is some level of safety and trajectory there that people can build upon. But if there's no access, if there's no acknowledgement that we need to look at alternative data types and alternative sources of income, if you will, and figure out a way to acknowledge that, to recognize it, to see it for the responsible patterns that people have, and utilize that as those predictors of risk and credit worthiness.
Yeah, that's really helpful, Grabetta. And I want to come back to you with questions about time frame and timelines and what you all are doing with Project Reach. Jason, I know we're going to lose you, but if I could squeeze in one question, because this question, and we see the questions coming in from those listening, what's the sort of architecture? How do the data, how are they accessible? What needs to happen from a market, from a policy standpoint? And when you and I were prepping, why is it so important that we make sure that the data is accessible from institutions by which not underserved markets are actually participating in? So any top line you can share with us before you have to bolt.
Sure. Thanks, Melissa. And apologies to the group today. I had a prior engagement that I couldn't get out of, but wanted to be able to join for the time that I do have. And I appreciate the opportunity to respond on this topic, because it's something that I've been very focused on. And I'm also very excited to hear from Grabetta the focus on infrastructure. And how, and sort of asking these questions of how the really useful data that may describe the creditworthiness of underserved groups can make its way into the system. This is what we've been studying for all the years that we've been in business building this company. And I think the most important issue right now relates to consumer access to data and open banking. There's great potential that we've seen in the approach that we've taken to underwriting consumers that typically are not underwritten or typically are not afforded access. But all of what we do, and Michael referred to this as well, all of what we do is based on technical infrastructure and policy infrastructure that is not fully formed and is somewhat shaky in the current environment. So there's no genius insight to the way that we underwrite. The idea of using data that describes income, expenses, assets, this information is used every single day in a small business context, in a mortgage context, but using paper files, right, and manual processes that are simply too expensive to feasibly be applied in small dollar lending, where we're on the front lines of access, right? So you have to be able to access the data in a way that is more efficient, that is digital, that's in line with new emerging technologies and innovations. And so consumers must have the reliable ability to access their own financial records and then use those financial records to demonstrate their creditworthiness wherever they seek to bank or whoever they seek to work with. That's really sort of the vision of consumer data access that's promised in Dodd-Frank 1033, and the extent to which consumers can access their information will determine whether approaches like what we do at Petal, some of the really exciting approaches in the small business side as well, whether those can actually scale and make a big impact. And one, I'll leave with a little bit of data there so folks know sort of how far we still have to travel. There was recently some research done looking across all of the different data aggregators that sort of facilitate consumer accessing their banking records and transferring those to a destination of their choosing. Nearly 50% of attempted access by a consumer to their own financial data is unsuccessful today using the mainstream data aggregators. And so, many of us are aware of the, astronomical growth that we've seen, platforms like Plaid and Finicity and so on. That's happening with a 50% failure rate almost. And that means half of the people that want to be able to apply for a Petal product or a loan from the Opportunity Fund or all these other exciting new services, half of them will have that intent frustrated just because of where they bank and whether that bank has integrated into an open financial system. So there are entrepreneurs and innovators that are excited and rearing to use this data to expand access to the system. But consumers need the ability to leverage their own information and transfer it where they choose. It's absolutely critical, and it's not where it needs to be if we want to see these kinds of innovations.
That is really, really insightful. And we have people listening in who are saying, I'd love to be helpful to a system, to build a system that enables this kind of data transfer. But you're putting your finger on it. It's infrastructure, it's APIs, core questions around sort of who's governing around it, Chi-Chi, what the consumer protections are that come with this new system. And I can see you smiling. And then
I'm smiling because of the comment in the chat box.
Excellent. And public policy has an important role on this. Bye, Jason. Thank you.
Thank you very
Larry,
much.
I promise I have not forgotten you. I know you're out there. It would be really helpful because you've been at this, I won't say how many decades, but help us think about sort of how this evolution happens where new types of data are being brought in. And to be transparent for the audience, Larry has a deep background at FICO, but he's speaking here on behalf of his own personal experience. Larry, can you hear us and chime in?
Yes. So my version of the evolution is that the way let's call it consumer credit, but also small business to some extent, for a long time it was done by credit officers using human judgment. Right. That's what they had. And then in about the mid 70s and through the mid 80s, we were trying to provide some predictive tools using data to help the credit officers to make better decisions. So I want to emphasize it was a mix of domain expertise and also data and some kind of a credit predictive algorithm. But then when it came from about the mid 80s to the late 90s, the data-driven tools, and there were also some learning decision tools that were developed for higher volume, high-speed credit underwriting for both consumers and small businesses. And that has continued, and there's different types of analytics that have been gone beyond predictive analytics in the 2000s and 2010s. but I don't have time to go through that. But here's what I think we learn, or what we understand now, which goes back to the original question about why not, why now? Mm-hmm. So I think that it's very clear now that credit underwriting requires both assessments of credit risk and also affordability. I think Australia probably started that. And it's in the UK, and it's coming to the US, probably slower, but it's important. And the reason I touch on that, because we've all talked about banking data and cash flow. Well, cash flow will help absolutely for credit risk assessment that we've talked about, and we can attack the invisibles that we've talked about. But the other thing is that I believe that data will be very potent when it comes to assessing affordability. So you try to keep some people from getting into trouble. And so I would add that. And so I think that today also the best, going back to predictive analytics to getting new customers, is that I think we understand now that that what we care about is a robust blend of predictiveness, predictive power, if you like, and explainability. And when I look at explainability, it requires overarching transparency to be able to assess three things. Is this analytic tool, is it understandable? Once you get that, the second question is it credible? Does it make sense? And then the third one was, does it feel fair and unbiased? And as you dig into that, I think that one of the concepts, and I'll talk about it maybe later if there's enough time, that I think there's a concept of plausibly causality, as opposed to anything that happens to predict and it's correlated for some reasons, for different subtle correlations. Mm-hmm. So to me, when I think about fairness, I think fairness is in the eye of the observers. And I think if we try to identify all the types of players in the ecosystem in the US for both consumer and small business credit, it's the consumers and the businesses, it's the consumer advocates, it's the academic and governmental researchers, it's the credit lending business execs who's in charge, also the credit lender internal formal governance, especially as you get bigger institutions. There's also internal governance processes, and they review vendor stuff too, make sure that makes sense to them. And then the last one is in this ecosystem are the people that develop the analytics and their internal reviews. So that's a big ecosystem, and fairness is in the eye of the beholder. And the trick is to do the work so that just about everybody looks at it and says, "Ooh, that feels fair." So that's the challenge, and we now see it. And to the point is, it's a key element of explainability, and I think explainability now has a higher agency than it did 2 decades ago. 2 decades ago, it was all about predictive power. So there's some positive signs that we can move from here to a better place.
Yeah, that's really helpful. Larry, I know that you haven't said this explicitly, but it might be a useful pivot to come back and talk about small business. Some of the research that you've been doing and thinking about are sort of the taxonomies or categorizations of different types of data. And we've all been really focused on cash flow. It's been used in small business underwriting for eons. But it's worth stepping back and saying that is one component of non-traditional data for credit underwriting. And you're putting your finger on, there's credit risk assessment, then there's assessing affordability, propensity to pay. Do you want to just sort of quickly share with the audience these different types of data categories that you've been thinking about? Because I do think as we're contemplating here we are to where we're going, and even what we've seen in the small business lending sector in terms of using other types of data, whether it's underwriting or getting people into a loan product in the first place, these other types of data are not to be lost and not to be missed as we think about evolving the credit system.
So I'll do it very quickly because I think we're running out of time.
Yeah.
I have a simple mental model that builds on the principles that I just mentioned. And so the first level of data and variables are the standard ones. We've used applications forever that the applicant fills in, but we have credit bureau and libraries of variables into bureaus. We now have credit bureau trended data, and I'll just emphasize again, I think that's going to be helpful in affordability.
Yeah.
And then, so that's the first level. It's the standard stuff that's been using for a long time. The second level is what I call financial facts. And those are the examples. Cash flow is the one. I also think somebody mentioned just recurring payments like utilities, phone services, cable, etc. And FICO put a version that they called FICO XD 6 years ago in the marketplace. Why has it not been utilized? And the answer is, beats me, the damn stuff works. And now we have a new one called the Ultra FICO, which has cash flow. And I would say that our largest lending institutions are pretty careful, slow, and so they don't grab new things. Now there are pioneers and they're early adopters. Then there's a second bucket of fast followers, and then there's the proven onlys. And a lot of our lending in the US are proven onlys. And that's just my observation. And so, but there is, so the levels of financial facts, and that's what we're working on now. And that's what you've been talking about. That's what your organization's worked on. Because I'm a research fellow, the burning question every night is what's next? And so I've tried to develop a what's next, and I've been calling the level. So the first level is standard variables. The second is these financial facts. The third one is, I call them plausibly causal variables. Mm-hmm. And I'll give you just a simple example. If people, especially if you're young and you are kind of invisible, if you can demonstrate that you command a personal financial management principles, and do you have skills to just dealing with money? And I've found, by the way, listening to some of these, I forget what it's called, the consumer panels, and you listen to them. Mm-hmm. And I've concluded the people that are invisible, some of them are there because they've been burned so badly by the banks, they don't want to have anything to do with them. That's very clear. Trust. And they have, and so, but I will tell you, I was all over my 6 years with underserved. I was impressed how savvy they are. Yeah. Why are they savvy? Because they had to be savvy. Sure. And as I think Gravetta said, because it's expensive to be poor. That's right. And all of that is true. And so,
yeah, Larry, I hate to cut you off, but you're right. We are going to run out of time. And I want to make sure that we come back to Michael and Chi-Chi. Michael, it would be helpful to hear more about the small business side. And as we've moved into this conversation about what needs to change and how are we evolving it, you've got a really important point of view from the Cdfi world. Can you share with us more about what the opportunity and the need is in terms of Cdfis? And Larry, you know, you and I are going to keep talking and we will do more of these.
Yeah, I think, you know, one of the there are many challenges in the Cdfi world. You know, we're small. We rely in many ways on philanthropy. We rely in many ways on CRA because that's what keeps our you know, that's where we get our low cost capital. We rely on, in many cases, loan loss reserves. For instance, here in the state of California, we have several programs that we tap into that help us should we have a loss on a particular loan. And all of those are, you know, if you will, third-party help. So we have, you know, in some ways limited control over our own destiny. And then add to it, we don't have a lot of deep pockets for things like technology and infrastructure and marketing. And I'll talk about the first. The technology and infrastructure, you know, we've been fortunate in our situation to have, you know, some people who have significant industry experience to help us build and develop some of our infrastructure. Things like call centers and loan origination systems and things like that, which are, you know, standard fare for any bank or credit union or financial institution. In many cases, for the smaller CDFIs, those aren't standard fare. We've been fortunate to get, you know, grants and help from some for-profit players and institutions in our world to help us with that.
Yeah.
But I think technology is a big component and challenge for CDFIs, and even around things like information security, you know, and then that leads me in a way to the marketing side of it. You know, I spent many years in the financial and, you know, services industry and had no idea what a CDFI was. And most consumers don't know we exist. And unfortunately, that creates challenges on a number of fronts. Number one is when the need arises, they don't know we exist. And in some cases, they can't be served by banks. So they wind up with, you know, MCA lenders or other kinds of, you know, high cost lenders that someone mentioned are, you know, typical and very prevalent in, you know, minority neighborhoods and communities and things like that. Yeah. And in some cases, it's very frustrating to us because we sometimes get borrowers that come our way, and by that point, they are so heavily in debt to some of these organizations that it's really hard to help them. Yeah. Because, you know, we still have to take on the risk there, and boy, you look at that, you know, profile and you say, can we take that risk on? And so being able to be there for people and people making sure they know us. And then when they even know us, do they trust us? You know, they're just like every other financial institution. We have to ask them for their PII and their social security number, and we're going to pull their credit reports and all that kind of stuff. They have to have faith and trust that we can secure that.
Yeah, that's super.
That's really important. So I think those, you know, I've often said to people that I've known for years, this is the most challenging job I've ever had in 30 plus years in this industry, because in addition to your typical challenges around running a lending business, you have these other factors. Right. And so that's kind of the challenge for us as a CDFI, and therefore it's the challenge for us in our ability to serve the smaller and micro businesses, and particularly those in low, moderate income and minority communities.
Yeah, so much more to talk about and probe with you on that, obviously. We're almost out of time. Chi-Chi, I know you've been thinking about other approaches for trying to make sure that we are building fairness into credit access. Can you share a little bit? And I want to squeeze in a few minutes, Gravetta, because we want to come back to hear from you in particular about where things are headed next with Project Reach. Sorry for jamming both of you. We are capturing everybody's questions too, and we'll think about how we can be responsive to those, because that's an important piece of this.
Sure. And, you know, obviously this is the tough part, which is why we say 5 minutes for it, which is how do you address some of these sticky issues about inequality in the systems. I mean, it's interesting. I had a lot of agreement with what Larry was saying and what other folks were saying in terms of, you know, first of all, cash flow is very promising, and we do know that. It is explainable, and that and feels fair, and that's very important. It has that component of ability to pay, but it's not going to be a panacea either for racial inequality or for credit invisibility, and that is because, actually, as he says, there are folks who aren't even in the banking system. We have a lot of unbanked folks, and a lot of folks were driven out. It's not that they don't know about bank accounts or they never had them. It's overdrafts. You know, if you want fairness in the system, with respect to cash, getting people into the system with cash flow, you're going to have to address the overdraft issue and the problems and, frankly, abuses with overdrafts and overdraft fees. You know, you also need guardrails around cash flow. You know, other things are making these models, driving down the disparities in these models. You know, again, Larry and FICO are absolutely right. Before you had scoring, you just had human judgment. That was worse in terms of racial disparities, no question. But let's keep working on it. Let's try to get that gap down. And then, you know, the other thing to think about, and, you know, small business lending, I mean, we know there are these programs that are aimed at minority and women-owned businesses in small business, and those are allowed under the Equal Credit Opportunity Act under the umbrella of special purpose credit programs. This is actually in the law that says, you know, you can have programs to help folks who are disadvantaged, excluded, who wouldn't otherwise qualify because of disadvantage. And, you know, if you've had populations that have been discriminated against for decades, that's certainly a good reason to have credit programs for them, and not just in small business, but, you know, in other forms of lending as well. And it is something that I know there's a lot more interest in, but it's been underutilized, especially in the consumer sector.
That's really helpful. Lots more to probe on that too. Thank you, Chi-Chi. I'm sorry to cut you off too. Gravetta, you've got the last word. Would be great to hear from you where things are headed with Project Reach, especially as you're talking about models. And we had teed you up to talk about what's it going to take for this time for it to be different and the change to last. So take either one of those or both if you can, in all of 2 minutes.
Okay, well, on the speed dating round here at the end, what I would say is, you know, I do think the time is now because we do have this shared experience, but there's a window here. And I personally feel that we need to move while there is a collective, you know, the momentum is here. We're all focused on this. We've got all the right people, at least from Project Reach, but all of the panelists are all focused on this as well. So it shows that this is very, you know, it's a significant issue. We're all looking at it. From Project Reach, I think that we're trying to move, not to lose the moment. You know, sometimes government can move quite slowly, ironically, but I do think that, again, we've convened a lot of, you know, stakeholders who also feel the need to move to get something that can be tested, piloted, so that we can, you know, implemented, exactly. So I think, you know, that's my quick answer to both things. I think now is the time because we do all see it. It's not happening in one pocket. It's not just a government initiative. It's not just a business initiative. It's not left up to the fintechs. It is collectively seen as a problem that has to be addressed. From my standpoint, it is all about the fairness. And the fairness comes with transparency. Transparency for consumers, for the business users, the bankers. Everyone has to get on board, understand it so it can be implemented and scaled. Right. So that everyone can take advantage of it. So I would say stay tuned. Yeah. I am hopeful that you'll begin to hear about the progress and results of our 3 work streams in the very near future.
That's fantastic. I really want to thank all of you, and we need more time. I mean, and we need individual segments, and we do plan on doing a number of those because there's so much to probe and unpack here, but also just to keep things moving, to your point, Gravetta. So thank you all. Thank you, Larry, even though we cannot see you. We have captured the questions. I will check in with my team and figure out how we make sure that they exist somewhere A lot of good input and so many participants. Thank you all for joining us. And on that, we're going to close it out. But take care. Stay safe.
Cheers.
Thank you,
Bye-bye.
Melissa. Thank you, everybody.
Thank you.